My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be able to make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, teach, and explain how days like today can even happen. So call me at 1-800-743-CBC or tweet me at you, Cramer. Mergers matter. When companies start buying each other at a big premium to what the market's willing to pay, it tells you that stocks entirely, the whole market, may just be too cheap. That's one reason why we were today. The reward with Dow surged 529 points. S&P soaring 1.43%. NASDAQ jumping 1.26%. I almost given up on the NASDAQ. Now, after a Gobi Desert-like dry spell, today we got 3 deals.
House of pleasure.
All of which made me more bullish. Amgen's buying Horizon Therapeutics. Take a look at these. These are big prices. This one was for $28 billion. Coupa Software going private for $8 billion, thanks to a bid from Thoma Bravo. And then Weber, the grill company, it's being taken private by BDT Capital for $3.7 billion. Okay, taking them in one by one, no, but look at it all together. Each of these deals came at a nice premium, and they tell you a lot about the current state of the entire stock market. First, Amgen, Amgen was one of the first big biotech firms. They decided to follow in the footsteps of the old life pharma companies by picking off a younger business with some exciting drugs at a 15% premium, although it's nearly double where Horizon was trading before we started hearing rumors of a deal. Amgen wants Horizon for its portfolio of orphan drugs, super expensive drugs aimed at incredibly rare diseases that are also incredibly severe, tend to be well covered by insurance, very lucrative. They say the deal will be additive to earnings in 2024. That's pretty quick. My initial reaction was that the deal was too expensive. There was a 3-way bidding war. Horizon with Sanofi and J&J dropping out as the price grew too high. I also didn't understand the need for Amgen to pay up because I thought their own pipeline was so compelling. Why they need anything else? But after hearing from them, I got to tell you, I'm getting convinced this is a good deal. First, this is a rare merger that should close quickly because there's no real overlap of drugs. Second, Horizon had no real worldwide infrastructure to market their drugs, something that costs a fortune. You got really a lot to build it out, but Amgen can just plug it right in. They already have it already. Third, the price is easier to justify when you realize that Amgen's confident of a quick payoff. What really matters here, though, is that there are a ton of companies that look just like Horizon Therapeutics, companies like Prometheus Biosciences. We heard from them on Friday. I like that story. BioMarin, frequent guest of the show, JJ Anime. Seagen, which has a very good cancer franchise. So many others. The deal is huge for the overall market. We've got so many biotechs that have come public in the last few years, and most are now wallowing without enough cash to really fund their big drug trials that they need in order to fully commercialize the stuff that gets approved. I'm involved in one of these. It costs a fortune. When Pfizer bought Biohaven Pharma for its migraine franchise back in May, paying $11.6 billion, I thought it might signal a scaling of biotech deals. It was one-off. Since then, the market's come down big, making these potential takeover targets much more enticing. There are tons of big pharma companies that need to pay to pad out their pipelines a lot more than Amgen did. Look for more deals like Amgen buys Horizon Therapeutics. Next up, let's talk about Thoma Bravo taking Coupa Software private. This is incredibly important because it says a cloud company that's losing fortunes might be of value to someone, anyone, even if it's hated by the stock market. Of course, Thoma Bravo seems to have a predilection for buying enterprise software companies that the market hates. They bought Anaplan for $10.4 billion, SailPoint for $6.9 billion, and Ping Identity for $2.8 billion. All at sweet premiums. None of these companies was making any money. They were losing boatloads. But that sure didn't stop Thoma Bravo. See, this firm just raised a new fund worth $32.4 billion, and it's precisely to buy companies like Coupa. So it's expected to buy many more companies in the space. And that's a big deal for the flag NASDAQ because nothing is as hated as the cloud software stocks. Coupa had fallen from $27 billion market cap early last year down to $3 billion last month. Thoma Bravo's paying $8 billion. Might seem like a huge premium, but they're basically paying what Coupa was valued at in March. Enterprise software, black hole. Now, I like Coupa, the company. We've had them on repeatedly. They dominate the procurement software space, saving billions of dollars for the customers. But Wall Street has no time for the cloud software names that are only focused on revenue growth, not profitability, even if they're young enough that the growth fixation makes perfect sense. When the Fed declared war on inflation a little over a year ago, everything like Coupa immediately went out of style, which is how the stock plunged from $377 to $40 at its lowest last month. And look, you can see the pin action from this deal, causing a huge wave of buying in the otherwise untouchable cloud software stocks. Of course, if we get on an overheated consumer price index tomorrow and then a surprisingly hawkish statement from the Fed the next day, well, I got to tell you, a lot of these stocks will go right back down, and that may be when we need to strike. But Coupa being taken private feels more like a floor than past deals, mainly because I never thought that CEO Rob Bernstein would sell. I mean, he's a young guy, loved the company. When you see Thoma Bravo taking these cloud software stocks private one after another, it's much harder for the hedge funds to short them aggressively because they're no longer shooting fish in a barrel. This private equity firm is basically putting a floor under the group. The more sophisticated people who watch the show say, Jim, why didn't you say it's put a put under the group? Okay, it's put a put under the group. It's an important cohort of stocks that have known no bottom this year. No one will think of these stocks as pariahs again after this purchase. Picking among the rubble. They're not necessarily even going after the best of breed. Finally, let's talk about one that shocked a lot of people. Weber, the grill company. Not long ago, the last week of October, the grill maker traded around $4 a share. That's quite a come down from $14, right? The IPO price in August of last year. Weber initially rallied to 20 after that deal, but it turned out to be a pure COVID play. Why? Because grilling outside was the safest way to socialize during the pandemic. Once the world went back to normal, demand fell off a cliff, and the numbers cratered. I remember chatting with the CEO Chris Scherzinger, on the day the company came public. We were outside doing some grilling, but I was babbling to him about the durability of my Weber. In many ways, that was the company's undoing. It's not like you need to buy a new grill every year, especially if it's a good grill, especially if it's a Weber. Again, though, the Weber private equity buyout at $8.05 per share, or $3.7 billion, made us rethink how much we should hate the other seemingly one-off pandemic plays. Even the DocuSigns, that stock's doing quite well since that last quarter. The Zoom videos. I was surprised that Weber competitor Traeger didn't do much. Now, I'm not saying these three deals ignited the entire rally today. I think the market got so oversold that some real buyers finally stepped up, and it did help that oil got stronger. Oil's been the leader in this market. But these deals certainly gave most buyers a lot more confidence. There are a ton of stocks that the market has no appreciation for, and we're finding out that other companies or private equity buyers value them a lot more highly. That's never a bad thing. Here's the bottom line. If it were one deal, just one deal, okay, it could be ignored. Two deals might raise some eyebrows. But three deals in a regulatory environment that's this hostile to takeovers, at that point, you need to get more positive on the entire asset class because the acquirers are telling you these stocks have gotten too cheap to be ignored. Nico in Illinois. Nico.
Jimmy Chill, a big booyah from Chicago for you.
Portillo's and Binny's, booyah, right back at you. Particularly Binny's, where my wife had a home run with the mezcal. What's going on?
Well, I want to know about your take on the VIX. So you are one who mentions the VIX when we get rallies. If we get a Santa Claus rally this year, do you think that we'll see the VIX rally with it?
I think that VIX will go down. I think that actually after Thursday, we're going to have some days where there's nothing else to do other than buy stocks, and that's what's going to happen. All right, acquirers are telling you these stocks have gotten too cheap to be ignored. I thought this was an amazing buyout day. Oh, man, money, honey, could an investment in Chewy give you something to chew on, or could you be barking up the wrong tree? Then, only one sector was higher in 2022, and I'm drilling into it tonight. I'll reveal it and whether it could continue roaring as we head into the new year, and I'll give you the best that I have. And after a tough year for the market, I'm highlighting one company that's managed to power higher. Do not miss my exclusive with the most exciting ESG company I know of. CEO of Constellation Energy is going to be with us. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.